Most traders operate under a fundamental delusion that has cost more fortunes than any other single misconception in market speculation. They believe that dramatic volume spikes automatically signal profitable opportunities, that explosive activity equals explosive profit potential, and that the loudest bars on their charts represent the clearest directional signals. This assumption appears logical, even scientific, yet it represents the most dangerous trap in all of trading. Wyckoff observed something that shatters this comfortable illusion entirely. He discovered that identical volume characteristics could precede completely opposite market outcomes, and that the most dramatic volume events often marked precisely when intelligent money exercised maximum caution rather than maximum aggression. Volume represents merely the effort expended. But effort without proportionate result reveals hidden professional manipulation rather than genuine market strength. Consider the architecture of deception in a single trading session. A stock explodes through resistance on the highest volume in months, creating what appears to be the confirmation every trader has awaited. The bar widens dramatically, the volume histogram towers above recent activity, and social feeds celebrate the breakout. Yet examine the result. The bar closes with a long upper shadow, finishing only marginally beyond the resistance level that supposedly surrendered. The following session opens firm, hesitates, then slips back into the range as if the door had never opened. This was not strength. This was distribution, a sophisticated campaign of selling into retail enthusiasm. The analogy clarifies what ego resists accepting. A revving engine in neutral produces impressive noise without forward motion. The tachometer reading appears powerful, yet the distance covered remains negligible. Thunder can be deafening without yielding rain, and pressure in a blocked hose can build dramatically, while the ground remains dry. Markets behave identically when professional opposition absorbs retail aggression. Tremendous energy is expended, but meaningful trajectory is denied. The composite man orchestrates this deception systematically across all market phases. During distribution campaigns near market tops, he requires substantial volume to absorb his selling without collapsing prices immediately. The volume explosion that retail traders interpret as bullish conviction actually represents sophisticated liquidation into desperate buying. Wide volume bars that fail to produce proportionate upward progress, that close poorly relative to their ranges, or that occur at logical resistance levels, often signal the beginning of significant declines rather than trend continuation. Accumulation phases reveal the inverse pattern. Professional accumulation requires absorbing panicked selling without driving prices higher prematurely. Heavy volume on downward bars that fail to produce proportionate decline, that show strong closes relative to their ranges, or that occur near logical support levels, frequently mark the end of declining phases rather than their continuation. This creates a profound psychological challenge because the bars that feel most exciting, that generate the strongest emotional responses, often represent moments of greatest danger. Meanwhile, quiet bars that appear boring or inconsequential frequently provide the safest and most profitable opportunities. Wyckoff taught that true market strength appears on the least obvious bars when professional money works in silence, accumulating positions while retail attention focuses elsewhere. The practical test becomes mercilessly simple yet requires disciplined application. Measure the spread relative to volume. Evaluate the close relative to the spread. Interpret both within the context of prior support, resistance, and climactic events. When high volume produces narrow spreads into overhead supply, someone is selling systematically. When modest volume yields persistent progress after clean demand tests, someone maintains control quietly. Hope represents the primary saboteur in volume analysis, consistently reframing clear distribution signals as building strength for breakout and causing premature exits from genuine accumulation patterns. Professional operators exploit this predictable psychological response, using dramatic volume to extract maximum retail participation at precisely the wrong moments. Discipline provides the antidote to volume deception. The fire insurance principle applies perfectly. Just as homeowners protect against rare but catastrophic loss, traders must approach high-volume bars with extreme caution because misinterpretation carries devastating consequences. True market mastery emerges not from chasing the loudest signals, but from understanding what those signals actually reveal about professional operations conducting business behind the theatrical display. Richard Wyckoff's analytical genius culminated in three fundamental laws that govern all market behavior with mathematical precision. His first law establishes that supply and demand governs all price movement as the foundational force. His second law demonstrates that cause and effect determines the magnitude and duration of market campaigns. His third law, the law of effort versus result, provides the real-time diagnostic instrument that reveals market intentions as they unfold, transforming abstract philosophy into measurable science. This third law operates on a deceptively simple premise that most traders overlook entirely. Effort represents the combination of volume, intensity, and price range characteristics within specific time periods, quantifying the total energy expenditure applied to moving price. Volume measures the participation intensity, while range indicates the battlefield scope where this energy is deployed. Result, however, represents something fundamentally different. The actual price progress achieved and sustained, measured not merely by intraday excursion but by closing position relative to range and the persistence of movement through subsequent periods. The diagnostic relationship becomes immediately operational through systematic comparison. When effort significantly exceeds result, absorption, or hidden opposition, is occurring beneath the surface activity. Professional money is working against the apparent direction, using retail enthusiasm or panic as liquidity to accomplish distribution or accumulation objectives. When result exceeds effort, ease of movement prevails, indicating vacuum conditions where minimal resistance allows substantial progress. When effort approximates result proportionately, normal trending conditions exist with balanced participation creating orderly price development. Consider the physics through analogy. A boat struggling upstream against hidden current expends tremendous energy while making minimal forward progress. The effort appears heroic, yet the result reveals a force stronger than the oars. Conversely, when the same boat finds the river's natural flow, modest effort produces substantial distance as the current carries the vessel forward. Markets exhibit identical behavior when professional operations either oppose or align with apparent price direction. Professional operators understand these relationships intuitively, conducting systematic campaigns that exploit predictable effort-result patterns. During accumulation phases, the composite man must absorb panicked selling without driving prices higher prematurely. This creates characteristic signatures where heavy volume on declining bars fails to produce proportionate downward progress, revealing professional buying. The bars appear bearish superficially, yet close strongly relative to their ranges and fail to continue declining in subsequent sessions. Distribution campaigns exhibit inverse characteristics. Professional selling requires retail buying enthusiasm to prevent immediate price collapse, creating high-volume advancing bars that fail to achieve proportionate upward progress. These bars appear bullish superficially, yet close poorly relative to their ranges and surrender their gains quickly. The effort appears impressive, but the result exposes systematic selling into strength. Time provides the ultimate validation mechanism for effort-result analysis. Genuine result persists through subsequent periods, surviving the test of follow-through and respecting structural logic. A breakout that immediately surrenders the level it claimed was never a breakout. It was theatrical distribution. True advances hold their ground, retest without drama, then continue progressing on ordinary effort as supply exhaustion becomes apparent. The fire insurance principle applies perfectly to risk management applications. Homeowners purchase protection not because fires occur frequently, but because the consequences of being unprotected during rare occurrences prove catastrophic. Similarly, traders must approach effort-result divergences with extreme caution because misinterpretation carries devastating consequences, while correct interpretation provides extraordinary opportunities. Wyckoff observed that genuine market strength operates efficiently, with the most profitable moves beginning quietly rather than dramatically. He taught that arguing with clear effort-result signals resembles arguing with rainfall while the river level rises. The outcome is predetermined by forces larger than individual opinion. This law transforms the chart into an X-ray instrument, revealing the hidden contest beneath every candlestick where victory belongs, not to whoever shouted loudest, but to whoever kept the ground when the battle concluded. Professional market operations create distinctive signatures that repeat across all timeframes and instruments with mathematical consistency, emerging from the fundamental physics of how large positions must be accumulated or distributed without disrupting price prematurely. These patterns crystallize into four recurring archetypes that expose institutional intent through effort-result relationships, transforming apparent market chaos into readable professional behavior. The first archetype emerges when substantial effort produces minimal result, manifesting as wide-range bars with heavy volume that achieve little net progress in the expected direction. This signature reveals absorption campaigns where professional money works against apparent momentum. During suspected accumulation phases, dramatic selling climaxes that fail to break key support levels decisively expose systematic buying beneath surface panic. The bars appear bearish superficially, yet close strongly relative to their ranges and fail to continue declining in subsequent sessions. Conversely, during distribution periods, explosive rallies into overhead supply zones that close poorly relative to their ranges reveal methodical selling into retail enthusiasm. The effort appears impressive, yet someone stronger than the crowd is quietly taking the opposite side of every transaction. The second archetype presents the inverse relationship, where minimal effort produces substantial result, indicating ease of movement conditions where little resistance allows significant progress. These quiet advance or decline bars cover meaningful ground on ordinary volume, revealing vacuum conditions created by successful professional campaigns. Like a boat finding the river's natural current, modest effort produces substantial distance as the underlying flow carries price toward predetermined objectives. Professional positions are now aligned with price direction, allowing natural progression without requiring additional heavy lifting. This ease typically follows successful tests of accumulation or distribution zones, confirming that supply has been exhausted or demand overwhelmed. The third archetype demands contextual interpretation, as substantial effort producing proportionate result can signal either healthy trending behavior or climactic exhaustion. Early in trending phases, wide-range bars with significant volume that achieve corresponding progress indicate robust participation and trend continuation. However, identical characteristics at extended price levels often mark climactic conditions, where maximum effort produces final result before reversal. The distinction lies not in the individual bar characteristics but in the structural context and subsequent follow-through. Genuine strength holds its ground and continues progressing on ordinary effort, while climactic action immediately surrenders territory and invites violent tests. The fourth archetype appears when minimal effort produces minimal result, suggesting market apathy or professional control during consolidation phases. These narrow-range, light-volume periods typically occur when the composite man has completed major campaigns and awaits optimal conditions for the next phase. Rather than indicating weakness, these quiet periods often precede significant moves as professional positions are established and retail attention diminishes. The market appears dormant, yet this controlled consolidation allows systematic preparation for the next campaign. Wyckoff observed that the sequence of these archetypes matters more than any single occurrence, because professional campaigns reveal themselves through repeated tests, progressive ease or resistance to movement, and the structural logic of the entire formation. The systematic classification transforms the chart into an X-ray instrument, revealing the hidden contest beneath every candlestick, where victory belongs not to whoever expended the most energy, but to whoever maintained control when the campaign concluded. Converting effort-result diagnosis into profitable execution requires systematic protocols that mirror how professional campaigns unfold, because recognizing institutional activity means nothing without the discipline to align with it rather than oppose it. Professional operators succeed through superior positioning, entering when risk is minimal and information is richest, regardless of emotional attachment to market direction. The accumulation spring provides the clearest example of effort-result analysis guiding trade execution. When suspected accumulation zones undergo final tests, genuine springs exhibit minimal effort producing minimal result on the downside penetration, with narrow spreads, reduced volume, and strong closes relative to bar ranges. This signature reveals that selling pressure has been exhausted while professional buying continues absorbing any remaining supply. The danger point for entry occurs just above the spring low, with protective stops placed beneath the formation where the professional campaign would be unequivocally invalidated. Risk remains small because institutional operations rarely allow meaningful penetration below established accumulation zones once their campaigns near completion. Distribution upthrust patterns operate through inverse logic, where substantial effort fails to produce proportionate upward progress into known supply zones. These formations emerge after extended advances when professional distribution requires retail enthusiasm to absorb systematic selling. The upthrust exhibits wide ranges with heavy volume yet closes poorly relative to the spread, often surrendering gains through the following session. Short entries trigger on failure back into the prior range, with stops above the upthrust high, because genuine breakouts hold ground and continue progressing on ordinary effort, while false breakouts surrender territory immediately. Absorption breakouts develop after repeated high-effort attempts against resistance levels yield poor results, indicating systematic accumulation beneath surface activity. The actual breakout occurs with ease of movement on relatively modest effort, confirming the path of least resistance. Entries are refined on retests of broken levels, with invalidation stops inside prior consolidation ranges, because professional campaigns respect conquered territory. Campaign management integrates multiple time frames systematically. Higher time frames establish dominant professional trends and structural context, while lower time frames provide precise entry timing within that broader framework. Position sizing aligns with effort result confirmation rather than arbitrary percentages, scaling appropriately when subsequent action confirms the thesis through continued ease of movement, while reducing exposure when relationships deteriorate, regardless of profit considerations. The most dangerous opponent a trader faces resides not in market complexity but in the narrative engine of the mind, a sophisticated storyteller that converts clear evidence into comforting fiction precisely when clarity matters most. This internal saboteur operates through predictable psychological mechanisms that professional operators exploit systematically, transforming disciplined analysis into emotional interpretation. Hope represents the primary destroyer of objective effort-result analysis, consistently reframing clear distribution signals as accumulation opportunities. When wide-range bars with heavy volume fail to produce proportionate upward progress at resistance levels, hope whispers that the market is building energy for breakout, rather than recognizing systematic professional selling into retail enthusiasm. Fear operates inversely, causing premature exits from genuine ease of movement patterns. When normal retracements create temporary discomfort, abandoning positions precisely as professional campaigns near completion. Greed drives traders toward the most dangerous formations on the chart, the climactic bars where maximum effort produces final results before reversal. The neurochemical reality explains this attraction. Dopamine rewards the chase more than the outcome, making high-volume, wide-range activity feel exciting and potentially profitable, even when effort-result relationships clearly indicate exhaustion. This biochemical response creates addiction to stimulation rather than edge, causing consistent gravitation toward market tops and bottoms. Ego refuses to acknowledge when effort-result analysis contradicts existing positions, while confirmation bias filters contradictory evidence to protect psychological identity rather than capital. Availability bias treats news-driven volume as meaningful effort regardless of actual price progress, and recency bias overweights the most recent dramatic bar while ignoring broader structural context. The composite man profits precisely because these psychological responses are predictable and exploitable, using dramatic effort to extract maximum retail participation at precisely the wrong moments. The antidote requires procedural discipline that bypasses emotional interpretation entirely. Pre-trade classification of effort-result relationships, systematic journaling that captures hypotheses independent of outcomes, and position sizing rules that prevent emotional scaling based on recent results rather than current market evidence. Wyckoff understood that successful trading represents a contest between logic and emotion, where victory belongs consistently to those who maintain analytical discipline regardless of psychological pressure. The most profitable traders often appear to do very little, because they wait for clear effort-result signals rather than forcing trades from emotional impulses disguised as analytical insights. True mastery emerges not from accumulating theoretical knowledge but from transforming understanding into systematic daily practice, where effort-result analysis becomes the foundational architecture governing every market decision. This integration process requires rebuilding trading methodology from first principles, establishing routines that mirror how professional campaigns actually unfold, rather than how retail imagination believes they should operate. The systematic approach begins each session with disciplined context preparation that establishes analytical framework before emotional involvement corrupts judgment. Current market phase identification provides the essential backdrop against which individual effort-result relationships gain meaning, because identical volume signatures carry opposite implications within accumulation versus distribution environments. Previous climactic events and structural levels create reference points that distinguish normal development from significant change, while effort-result hypotheses for likely scenarios prepare recognition of emerging patterns rather than reactive surprise. This daily routine transforms trading from profit-focused gambling into skill-focused development, through systematic measurement of analytical accuracy rather than financial outcomes. The scorecard approach quantifies adherence to logical procedures, awarding recognition for correct effort-result classification, regardless of subsequent price action, for entry timing aligned with danger points rather than emotional impulses, for stop placement at logical invalidation levels rather than arbitrary percentages, for exit execution based on predetermined criteria rather than fear or greed, and for detailed process documentation that captures hypotheses independent of results. This methodology redefines success as consistent application of sound principles rather than prediction accuracy or short-term profits, creating the psychological foundation necessary for long-term survival and prosperity. Practice concentrates attention systematically rather than scattering focus across multiple instruments and timeframes simultaneously. One primary market, one dominant time frame, and one or two recurring structural patterns receive concentrated study until recognition becomes instinctive. The disciplined operator journals 20 consecutive sessions of classified observations before scaling risk, then expands scope deliberately, integrating higher timeframes for directional bias and lower timeframes for entry precision, without diluting core analytical logic. Understanding effort-result relationships represents merely the beginning of professional development, because true expertise requires integrating this knowledge with Wyckoff's broader structural principles, particularly how cause and effect determines the magnitude and duration of market campaigns initiated by these very effort-result signals. The complete operating system encompasses multiple timeframes working in harmony, with higher timeframes establishing dominant professional trends while lower timeframes provide precise execution timing within that broader context. The moral insight centers on humility and patience, recognizing that consistent profitability emerges from disciplined observation rather than aggressive position-taking or complex indicator manipulation. The most successful traders appear to accomplish very little because they wait for clear signals rather than forcing opportunity from marginal setups. The composite man dictates tempo while the disciplined trader accepts boredom, silence, and inactivity as strategic positions rather than obstacles to overcome. In trading, as in all endeavors requiring sustained excellence, quiet competence consistently outperforms dramatic activity. Strength is measured not by the loudness of effort expended, but by the proportion of result achieved through systematic application of proven principles. Those who choose to formalize this routine may simply acknowledge their commitment with a single word and begin tomorrow with a chart, a hypothesis, and the patience to wait for confirmation rather than chase illusion.